Hi, I'm Wayne Connors, founder of Retirement Investor. Welcome to this month's investment update ending February 2015. In this update, we're going to review the year-to-date performance of the overall financial markets from January 1st to the end of February, the performance of our retirement investor model portfolios, then we're going to review the performance of the funds by investment category within the model portfolios and discuss recent changes that were made. But first, let's start by taking a look at the big picture to see what really moved the financial markets in February. If you've watched our monthly video updates in the past, hopefully you can remember that we always end our commentary by saying, so until next month, stay invested, stay disciplined, and make the markets work for you. Well, there's a reason for this. That's because in some months you're going to see the market decline. And you may ask yourself, is this a signal to get out of the market? The answer is always no. The number one reason investors underperform the market is because they withdraw money at low points and they buy near market highs. Unfortunately, the stock market doesn't tell us what day it's going to have its best return, so you need to stay invested. February's market performance was a great example of why this message is so important. We started the year off with the U.S. stock market dropping 3% in January. Then in February, we witnessed a complete turnaround as the stock market rallied over 5% in 1 month, hitting another record high near the end of February. The big question on every investor's mind is, when will the Federal Reserve begin to raise interest rates? The reason this is so important is because when interest rates are low, the stock market looks more attractive than bonds. And when interest rates move higher, it's seen as having a negative impact on stock prices. The most important event in February was the U.S. Federal Reserve's testimony before Congress. The Fed indicated that they are in no rush to start raising interest rates because first, inflation is very low, currently below the Fed's 2% target. And second, although the unemployment rate is dropping, the growth rate in wages remains weak. Investors had anticipated the Fed to start raising rates this June. However, it now looks like that won't happen until later this year, which is good news for the stock market. That said, let's take a look at the year-to-date performance of the overall financial markets so far this year, ending in February, and discuss what's really moving the markets. So far this year, U.S. stocks as measured by the S&P 500 index, which is a broad measure of the U.S. stock market, are up over 2.5% ending February. So why did the U.S. stock market go from being down 3% in January to being up over 2.5% by the end of February? Because the Fed probably won't raise interest rates this June. Looking at international developed stock markets, we've seen a greater rise in stock prices, with their year-to-date performance up over 6.5%. This is because that while the U.S. is preparing to raise interest rates, developed countries outside the U.S. and Europe and Japan are actually lowering their interest rates in order to stimulate their sluggish economies, which is causing stock prices to rise. While countries in emerging markets are not lowering their interest rates, they're still experiencing a rise in stock prices due to the fact that their economic growth rates are higher than the U.S., and their stock markets are almost 40% undervalued compared to U.S. stock prices. During February, bond markets in both the U.S. and foreign countries experienced a decline of roughly 1% in the U.S. and just over 0.5% overseas, as investors move money from low interest-bearing bonds to the stock market. Now let's take a look at the year-to-date performance of our model portfolios at Retirement Investor. Our model portfolios make it easy for the average investor to invest like a professional by showing you how to build a diversified retirement portfolio across 12 investment categories using low-cost index funds. The model portfolios with larger percentages in stocks performed better in February. The conservative portfolio holding 20% stocks and 80% bonds has returned 1.6% year-to-date. The conservative moderate portfolio with 40% stocks has returned 2%. The moderate portfolio, holding 60% stocks, has returned 2.3%. The aggressive portfolio, holding 80% stocks, has returned 2.5%. And the total equity portfolio, holding 100% stocks, has returned 2.8%. Next, let's take a look at the year-to-date performance of the funds within our model portfolios by investment category to see what contributed to our model portfolio's performance. In the U.S., we replaced our S&P 500 index fund representing both U.S. large growth and value companies with the low-cost U.S. large cap growth index, because growth companies have been providing more performance stability during periods of high market volatility. This fund has returned 4.6% year to date. We lowered our allocation to U.S. large cap value, which is heavily allocated to financial companies, which are more interest rate sensitive. This fund has returned 1% so far this year. Mid-cap value has returned almost 3%, and we added a U.S. small cap growth index fund to our models for the same reason we added large cap growth. This fund has returned 5% year to date. And finally, small cap value has returned 2.2%. Just for reference, small cap value historically is the best performer among all U.S. asset classes over time and should always be a part of your portfolio's asset allocation. Looking overseas at international developed markets and emerging markets, we increased our model allocation to our International Large Cap Index Fund that invests primarily in European countries. This fund has returned 15.7% year to date. What's unique about this fund is that it's protected from the euro declining in value against the US dollar, which is expected to continue, while international small cap companies have returned 7.3%. We have maintained our allocation to emerging markets, which is also having a positive year. Emerging market large caps have returned 4.2%, while emerging market small caps have returned 5%. REITs representing real estate stocks, which had risen nearly 32% in 2014, has returned 3.1% year to date. And our broad U.S. bond market fund, which seeks to track the performance of the total U.S. bond market, has returned 1.1%, while our recent new addition to our model portfolios, foreign bonds, has returned 1.6% and should continue to benefit from declining interest rates in foreign countries. So looking ahead, what's our thoughts on the future positioning of the model portfolios and whether any changes are expected? Although the U.S. continues to exhibit the strongest economic growth globally, we may continue to increase our model's allocation to international large cap companies in Europe, since the stock markets in this region continue to be undervalued compared to the U.S. stock market. However, we're using a currency hedged index fund that offers protection against the decline in the euro in the event the U.S. dollar continues to rise in value. As an example, if the stock markets in Europe rose 10%, but the euro declined 10% against the US dollar, an investor's return would be zero. However, by using a currency hedged fund, it acts like a currency neutralizer, so an investor's return would be 10% if Europe rose 10%. In regards to growth and value, while value companies have higher expected returns long term, and we consider them the foundation of our model portfolios, we may continue to increase our allocation to growth companies if the stock market volatility continues to be high. So, until next month, stay invested, stay disciplined, and make the markets work for you.